Hello and welcome to the most awaited interview of the past several weeks. I have with me the man who has all the answers to the questions of the financial sector. I have with me Shaktikanta Das, Governor, Reserve Bank of India. Governor, I must tell you that this is going to be the most watched, most awaited discussion after the budget for the financial markets. They're hanging on every word. Let me start with the budget itself and this big borrowing program. The 4 auctions after that have, practically been either partially failed or fully failed. Do you think the bond market has not got your message? Do you want to give a message to the bond markets?
You see, if you go back into my monetary policy statements, right from October onwards, October and then again in February, I have given a very clear signal and explicit guidance to the bond markets. What I have said is that in RBI, we are expecting to, a cooperative working with the market, and we do expect an orderly evolution of the yield curve. Now, an orderly evolution of the yield curve has to be orderly. It cannot be otherwise. So therefore, the market perhaps was surprised by the borrowing number, but then there was all-round demand and there was all-round expectation that the government should spend more, particularly in the context of the COVID, to give a boost to the infrastructure sector. I myself have articulated this view as early as July or September in my interaction with one of the industry associations that a significant thrust should be given to infrastructure. So government had to do it, especially in an environment where private sector investment is yet to take off. So now the expectation is that the infrastructure spending by the government, which incidentally improves the quality of expenditure of the government, it is expected now that the infrastructure spending of the government will sort of crowd in the private investment. So therefore, it was a larger goal which the government was pursuing. Now, the market perhaps thought that the borrowing requirement of the government is slightly higher than what they expected. But we have to keep in mind that it is gross borrowing of 12 lakh crore. The net borrowing is about 9 lakh crore or so.
They were expecting a net of 7 and a gross of 10. Then I did
whatever it is, what I am saying is that it's not 12, it is 9, because 3 gets refinanced by the, by the redemptions. That is number 1. Number 2 is that look at the RBI's actions over the last 1 year or even this year. This year, this financial year, that is 2021, from April till now, we have done a total OMO of 3 lakh crores, more than 3 lakh crores. Considering the borrowing requirement of next year, there is no reason why RBI should do less OMO in the next year, that is 21-22, than what we did in the current year. Now, how much of OMO we will do, that's a different issue. But I am just saying that having done 3 lakh crore in the current year, one can reasonably expect that it has to be 3 lakh crore, or it will depend on how the situation evolves. We have again extended this dispensation which we gave for HTM.
Yes.
Now that opens up space for another 4 lakh crores. Now let's do the arithmetic. 3 lakh crore of OMO of last year, it could be even more. 4 lakh crore space created because of the HTM dispensation, 7 lakh crores. Your net borrowing is 9 lakh crore. So therefore, the borrowing requirement of Government of India is very much manageable. If you recall, after MPC, I had said very clearly that we will ensure that there is a, non-disruptive borrowing which will take place. And through you, I would like to sort of assure the markets that what we are looking at is an orderly evolution of the yield curve. It cannot be, disorderly, or it cannot be sudden. It cannot be sort of out of sync with the evolution of the yield curve. And when it becomes, when it falls off the track, as the central bank and as the debt manager of the government, RBI will obviously take whatever policy measures are required. But liquidity will continue to be sufficient. We will make available liquidity at the appropriate times, and we will see that the borrowing program goes through, in a very orderly manner.
Okay. I have a couple of questions so that I'm sure what you have said now itself will soothe the market. But after we put out that you are going to speak on CNBC TV18, there was a lot of feedback from the market that I got. And one of the worries I sensed in the market participants is that even if you want to intervene, you are held back by the reality. I mean, too much of liquidity. There is, the MPC minutes indicate there is a fear of inflation, CPI inflation, a fear of asset inflation, which can be financially destabilizing, mispricing of assets. So that's holding you back.
You see, situation is never easy and it is never a straight line evolution of the economy. There will be always, there will be developments and evolution of, economic activity in multiple directions. We have managed it reasonably well, I can say. It's for others to judge, but I think we have managed it reasonably well and to our satisfaction during this entire COVID period. For liquidity management, we have several instruments on our table. There are several instruments. As and when the time is required, we will use various tools either to inject liquidity, or now I have made very clear that pulling out liquidity, it should not be done prematurely in a manner that it could stifle growth. We don't want to create an impediment to the process of revival of economic activity. But as and when at a future date it becomes necessary, there are enough number of instruments available with the RBI, some of which have been used in the past. And so the central bank always has got many known and unknown tools to deal with the liquidity situation. And even today, I mean, there is a large quantum of forex inflow which is taking place, but we are dealing with that situation also. So markets should, take cue from the signal which the central bank has been giving from time to time, and market should trust the RBI.
Yes. So I think the market is absolutely impressed by the work the Reserve Bank did in FY 2021. No one is even scrounging on objectives. The way proactively Reserve Bank, TLTRO, the provision of liquidity, CRR cut, you name it, it was completely ahead of the curve. But now, a lot of central banks are giving direct messages. Of course, everyone's giving a forward guidance, plus maybe QE, forward guidance, plus yield curve control, like say in Australia or Japan. Whereas your methods are not direct. RBI's methods are more like indirect, refusing an auction or something like that. Would you want to think of, a more direct OMO calendar, some direct way of reassuring?
I think our forward guidance has been, much more explicit than they have been ever before.
Yes.
And depending on country situations, each central bank evolves its own method of communicating with the market. It has to be a mix of your actions and words and signals. There are some subtle messages also which the market should read. For example, in the last monetary policy statement, when I read out the statement, I said that we will, the calibrated unwinding of the calibrated, increase of the CRR opens up space for liquidity infusion. I got a feedback from the market that the governor did not use the word OMO. Okay. Now, the point is the signal was sufficiently clear. So market should read that signal. Yes. So therefore, messages from central banks will depend on country situations, and the messages from the central bank are always a mix of words, actions and subtle signals.
Okay. So, take your point entirely, but this liquidity excess of 11 lakh crore, 9 lakh crore creates its own problems. So are there other tools, like for instance MSS, is that on the table, or will you have to remove liquidity, reduce liquidity because it can create mischief? MSS or increasing SLR, I don't know.
You see, at the moment, we are okay with the level of liquidity which is there, and we have assured provision of, the RBI, and on behalf of RBI, I have assured that RBI will ensure availability of ample liquidity. We stand committed to that. Several instruments have been used in the past to deal with situations like this. All instruments are on the table. If required, we will evolve new instruments. I don't rule out any possibility or any instrument.
Okay. So just a minor thing on this, if I go on with bond markets, the equity market viewers are going to beat me up. Just one word more, SDLs, the state loans, you did one OMO to purchase them. Now the open market was more for Government of India bonds. Is that also on the table, purchase of SDLs, because their yields have gone up by 50 basis?
You see, SDL, when we announced for the first time in the last year, in the current year, we did SDL, and my recollection is we did 2 or 3 OMOs, not just one, we did 2 or 3, and we have practically covered all the states. Now, the current dispensation is till 31st March, and it is still there. We will evaluate the situation and take a call as may be required.
Okay. Will you also, I mean, there is a lot of attention placed on tenure in your intervention and even in references, common references. But actually corporate sector borrows off the 5-year. Most of their loans are 3 and 5-year. And once before you all had even, intervened in the 5-year part of the yield curve. Is that also an option?
You see, tenure perhaps
only helps the government.
Tenure perhaps is visible, is more visible in terms of our action.
Yeah.
It is possible. Yeah. But we are looking at a range of, I don't want to specify, I don't want to sort of, but we are looking at a range of bonds. It is not just tenure, and we are very sensitive to the fact that, in fact, why do we do yield management? It is not just government borrowing requirement, it is also the cost of borrowing for the private sector.
Yes.
Because the private sector borrowing from the market, whether it is corporate bonds or commercial paper, they are all benchmarked on the GSEC rates of corresponding maturity.
Yes.
So in that sense, a 3-year bond or a 5-year Government of India bond or a 10-year or whatever be the tenure, they are all important.
Yeah.
So therefore, it is not just we are focusing on 10, we look at a spectrum of bonds.
Okay. So, ultimately it is the banking sector which has to take the load. And they could take 12 lakh crore last year because they were staring at an abyss in terms of, growth. But now, growth is 11%, 10-11% is the forecast. Is your forecast also as strong for next year?
We have given 10.5.
Yeah.
10.5% is our forecast for next year.
So considering that, where else, if banks are, because they're going to see growth, they may be unwilling to buy the same amount. Also, there is a MTM loss. If they see yields jumping as they have seen abroad, there is that reluctance to buy. So what is the option? Who else? It has to be RBI. Or one was expecting the bond index inclusion. Is there any?
You see, so far as the bond index inclusion is there, we are constantly engaged with the, the concerned agencies. And with regard to the, inclusion of India or India's participation in the Euro Clear, that kind of facility also, we are in very advanced stage of discussion with the authorities on the other side. Both government and the Reserve Bank, we are fully engaged with the authorities on the other side.
Okay. So hopefully that will open, a window. The other big window that was there in the monetary policy announcement is that you will create a retail segment to buy bonds. At what stage is it? There is a lot of hope. If you're only going to give me 6.5% or 6.15 for a 10-year, and tax adjusted, it will be like 4.5. It may not attract attention.
No, let us see there. It is work in progress. We have a whole team of RBI working on it. There is a technology aspect also.
Yes.
And all these details are being worked out. And we will be issuing some guidelines in the next few weeks.
Okay. No, I mean, will there be like ATCC or
Let's wait for
or
that to
repo
come.
ability? Is that even an option?
I think you will know when when we issue the guidelines.
Okay. I mean, that will be one outlet for the bond market. Okay, let me now come to the other things that the retail sector is eagerly waiting to hear from you. Cryptocurrencies. A lot of central bankers have spoken against it. What is your view?
See, we have certain major concerns about cryptocurrency. We have communicated them to the government. It is under consideration in the government. And I do expect, and I think sooner or later the government will take a call, and if required, the parliament also will consider and decide. I want to also make it very clear that technology, that is the, the blockchain technology is different.
Yes.
Blockchain technology has to be, the benefits of it have to be exploited.
Yes.
That is another thing. But on crypto, we have major concerns from the financial stability angle. We have shared it with the government. Government will consider and take a call.
Okay. So, will you be issuing digital currency sometime soon? That was another announcement you made. And some people are linking it even to this retail window that you are opening.
No, they are two
different
things altogether. In fact, completely different.
Okay.
Central bank digital currency, it is again work in progress. We have again a lot of work is going on. There is again the RBI team is working on it, both the technology side as well as the procedural side, how it will be launched and how it will be sort of rolled out. It's still work in progress, and we are very much in the game. We are targeting to launch it. If you ask me a date, at this point of time, it will be difficult for me to say.
But FY22,
because
you think it's...
I don't want to, guess a date.
Okay.
It will be very difficult and not possible for me to say a date because several loose ends need to be tied up, but it's receiving our full attention.
Okay. No, the government did a superb job with UPI. So clearly this should not be very difficult for them.
Please don't forget the role of RBI in UPI
I'm sorry,
also.
I should have said RBI did.
No, government.
I mean, MPCI is really your body, so...
Yeah, it is the government. I mean, always government is at the forefront, but RBI has contributed also.
Well, now that you say that, did they take you into confidence when they configured the deficit number? Did they ask you, will you be able to, as the merchant banker, manage 12 lakh?
No, these are always discussed. These are always discussed with this is always discussed with the central bank. Always. I mean, having worked in finance ministry, I can tell you with confidence that the borrowing requirement doesn't come as a surprise to the central bank on the date of the budget.
Okay. Okay, so to come back to other issues, the market and I guess even foreign investors, the economy is waiting for the monetary policy framework, which is, the target has to be rethought or reviewed. There is an internal working group of the Reserve Bank. When should we expect that report? And when should we finally get to know whether it is 4% plus or minus, whether it will be different?
You see, that report will be out very, very shortly in the next few days. So far as inflation, flexible inflation targeting is concerned, I would like to preface it by saying that this was a major structural reform undertaken by the government in 2016. And over the last 5 years, the gains of this structural reform are visible. Inflation expectations of households and businesses are well anchored. But for these COVID-related, these COVID months when suddenly it crossed 6%, inflation expectations have been well anchored. And when inflation expectations are anchored, inflation remains around the target of 4%. Whom does it benefit? It benefits the households. It benefits the average, it benefits the common man. It benefits the economy also because it gives confidence to domestic investors and foreign investors about the stability of India's inflation. So it encourages them to lend into a market where inflation is stable, both domestic and foreign investors. And also the other aspect that lies is that the current framework has enough width, this plus 4% plus minus 2, has enough width for the central bank to deal with extraordinary situations like the COVID. During the COVID time, the MPC has been tolerant of inflation above 4%.
Yes.
Now, this band of 2% on either side of 4% gives enough space to the central bank to deal with extraordinary situations. So I would believe that the current framework has ensured that the country, I mean the major structural reform which the government has undertaken and the current framework which has been outlined by the government, I mean through a parliamentary legislation, we have achieved a lot, and the gains of this, the gains and these achievements need to be preserved, consolidated and nurtured.
Okay, you clearly put your weight behind the current targets. What about the MPC's powers itself? You know, rates have gone below the reverse repo, and reverse repo became the operational rate. Would there be some rethinking on giving the MPC more instruments or something like that in the review?
No, the law is very clear. The law expects, the law is very clear that the repo rate, I mean the policy rate, the price stability has been defined, the policy rate is defined in terms of the repo rate.
Okay, okay. But, you did try to withdraw liquidity from, with the variable rate repo so that the reverse repo becomes the operational rate. Now again, we are seeing some yields below that. Is that a bother?
No, that was a temporary phenomenon which happened because of so many other factors. We are aware why it happened. And so far as you mentioned about this term reverse repo.
Yes.
Now it's a part of our liquidity management toolkit. It's not as if we were trying to suck out liquidity or anything or like that. In fact, February of 2020, when we spelled out our new liquidity management policy, the 14-day reverse repo window was the main tool for yield, for liquidity management. Okay. Now, when everything is coming back to normalcy, even in the Reserve Bank, we have now back to normalcy. All the entire staff and officers, everybody is attending. So it's back to normalcy almost everywhere. So we thought, let us go back to the 14-day reverse repo window. But having done that, we have also kept the overnight window open. So that market is assured that the RBI, market is assured that liquidity is available.
No, but of course, VRR is one way of treating that liquidity. You can even increase the VRR quantity, but you can also open the reverse repo window to non-bank participants. That was one of the expectations. It's not on the table.
At the moment,
mutual funds have the money. That is the problem.
No, at the moment, we don't have any such proposal.
Okay, okay. So now let me come to what the equity market is really looking for. The internal working group, which spoke about bank licenses and said that conglomerates should be, allowed to hold bank licenses. What is personally your issue? The Reserve Bank will come with, comments from the public, but you are a financial sector veteran, policy maker, both from government and central bank. How do you look at it?
You see, as long as I sit in this chair, I have no personal views. My views are those of the Reserve Bank of India. But the internal working group has, thrown up some very interesting suggestions, and they definitely merit consideration. There should be a free and fair debate. And we had asked for public comments up to, I think, January 15th.
Yes.
The comments have come in, and we are examining them, and we will take a decision.
So you're open to conglomerates, we should say?
I will not say anything. We are open to something or close to something. The comments have come in. The comments are being examined, and we will take a call.
Okay. This non-operative holding company structure also was part of the working group's discussion. Even that will be dealt with along with them, not separately, not outside?
Yes, it will be dealt with as a part of this.
Of the licenses?
Yes.
And what about NBFCs? The working group specifically said that there are some NBFCs, and if they're working for the last 10 years, normally they could be given licenses. Now, if they are part of conglomerates, also RBI will be okay?
No, we are looking at the report of the internal working group holistically.
Okay.
And examining each and every comment. And we will take a decision on all the recommendations which are contained in that report. We will take a call on all the issues.
Okay. Now, prior RBI dispensations, barring one, has been wary of conglomerates because there could be interested lending, conflict of interest. Is that something that will...
You see, so far as conglomerates are concerned, I mean the CICs, we have come out with, core investment companies. We have come out with a new set of guidelines, and we have only said that there can be 2 layers of, CICs, so that this multiple layering and leveraging at every step leading to over leveraging of the group, that has been by and large plugged.
Yes.
So therefore, all aspects of the report will be examined, and we will take a decision.
Okay. No, it's more that if you give it to if you give a banking license to a conglomerate, they may start lending to the consumers of their products or to their suppliers. That kind of connected lending was a big fear in some RBI earlier dispensations. Of course, there were some who did not as well. So,
I think the committee itself has recommended that related party lending needs to be, the guidelines they need to be strengthened. And I think they have also recommended that RBI should consider in terms of strengthening the legal provisions, under the law to strengthen the, the framework of the guidelines related to related party lending. That is one of the recommendations of the internal working group.
So you think...
So let's wait for RBI's decision.
Okay.
I don't want to speculatively say yes or no on any of the issues.
Okay. Well, I just want to come back to the borrowing program for a bit. I did an extensive poll before the budget. And like I told you, the poll said that borrowing calendar would be 10 lakh crore. The poll also indicated that GDP would be 225 to 229 trillion rupees for next year, whereas the government has gone with 222. As well, tax growth. My poll had thrown up between 16 and 20%. The government has assumed only 14.9. What is your own internal RBI assessment? Are they extremely conservative? Is there a chance, therefore, that the borrowing calendar will be less than what is mentioned?
You see, in budgeting, it is always better to be conservative.
Okay.
Having worked in budget, both at the state and in the central level.
That was not the practice so far, sir. There have been instances of, very liberal assumptions.
No, let me tell you, it's always better to be little conservative. Yes. Not excessively conservative, but it is always better to be a little conservative because anything extra that you get is a bonus. So in revenue projections, you must always assume what you are, what you will definitely get.
Yes.
As I've been revenue secretary also. So in revenue projections, you must take that number about which you are absolutely sure.
Yes.
And if you increase it, if you improve upon it, that is the bonus. Similarly, in expenditure side also, you must plan appropriately and not over budget because then you end up by borrowing excess amount and you will not be able to spend. So both in the expenditure and in the revenue side, it's always better to be little conservative and anything extra that you do is a bonus.
Okay, so you think that this year we could get a bonus in FY22, that is?
Let's see how the year has not started.
Yes.
In fact, the FY21-22 has not started. And so let the year start. Okay. I think perhaps sometime in the middle of the next year, we will be in a better position to assess. In any case, the government also reassesses and reviews its revenue and expenditure patterns. And that is why they have a revised estimates also.
Of course. Okay. So let me come back to the banking sector. In fact, I haven't really gone into the depth of the banking sector at all. The Reserve Bank stress test had guessed that the stress could be as high as 13.5% of total book NPAs because of COVID by September 21. Now, after the State Bank of India results, which indicated a much lower slippage, is the RBI looking at a new number at all?
You see, first thing I want to say, and which is very clearly written in the financial stability report of RBI, in fact in every report, and this time I think we have put it in bold letters, that the projections of the Reserve Bank with regard to non-performing assets, they are only projections, they are not forecasts. And these are projections made under various adverse scenarios. We assume a baseline case, then we assume a stress case. So under various stress situations and scenarios, we make projections. The objective of these projections is not to make a forecast. In fact, report very clearly says that this should not be read as a forecast. The objective of this projection is it is a stress test of the stability of the financial sector, and if it shows some fragileness somewhere, that is that gives a message to the banks to go for additional capital mobilization and strengthen their buffers. In fact, this point I have been stressing throughout this year, and I'm happy to note that many private and public sector banks have mobilized additional capital and have strengthened their buffers.
But RBI knows more about the financial sector than anyone else. I mean, the CRILIC is with you. Even otherwise, you have your supervisors and teams. So do you think that 13.5 was, an outside case and it could be better? Do you have or worse? Because, Michael Patra's minutes say that the financial stress on banks could intensify when the camouflage, I'm quoting him, when the camouflage of moratorium, asset classification, standstill and restructuring are over. So is there still a fear it can be as bad as 13, or will it be likely less?
No, I won't say fear, but there is that element of uncertainty because, the resolution framework which we announced on 6th of August, 6th
Yes.
of August 2020, there, the assets are getting restructured now
Yes.
under that. There is a standstill ordered by the Supreme Court
Yes.
from 1st September onwards. So as and when that standstill ordered by the Supreme Court, when that is removed by the Supreme Court, and as and when this restructuring is completed, then we will get a clearer idea. So I would therefore say that there is a baseline scenario where we say that in the baseline scenario, the stress could be 13.5, and in the worst case scenario, in the
Yes.
severe stress scenario, it will be higher. So therefore, there is an element of uncertainty. It is more, it's not meant to be a forecast. I'm just repeating
Yes.
myself. It is meant to be a projection and giving a message to the banking system that prepare your buffers, strengthen your buffers.
Okay. Well, no, I mean, the market still is trying to guess. I mean, if the financial sector's legacy bad loans are over and done with, then you have a different view of growth. You have a different view of their ability to lend loans. So that's why, I'm pondering over this question.
I'll reply it in two ways. One, going into this pandemic, if you compare ourselves with the global financial crisis, going into this pandemic, our macroeconomic fundamentals as well as the banking sector parameters were far stronger than what they were earlier.
Okay.
In 2008, yes. In terms of the NPA, etc. Now the entire NPA is on the table.
Yes.
Thanks to the, the CRILEC system which you mentioned, and of course earlier the RBI had done asset quality review, that also had its impact. So we entered into the pandemic in a much stronger position than the previous crisis of 2018. And my expectation is that we will emerge out of this crisis in a much better shape than we did in 2008.
Okay, that's good to hear, sir.
Both in terms of the strength of the economy, the growth numbers, and also the stability of the financial sector. We will emerge definitely better than what we did earlier.
Okay, that's very good to hear, sir. The economic survey said that maybe the RBI should do another AQR in the post-COVID period. Is that something like that on the cards?
Between 2014-15 when the AQR was done and now 21,
yes.
5-6 years have passed. The CRILEC data system has become far stronger. At that time, the CRILEC was not there. So today we have a precise idea of how many loans in which bank the default is less than 30 days, the default is 60 days, or the default is more than 60 days but less than 90 days. We have a clear picture of that. And we have also, I have been saying about it time and again, maybe on another occasion I can go into the details, but our supervision methodologies and approach are today far deeper than what they were earlier. And we today have a very precise idea of what is going on in which bank and what is going on in which NBFC. In fact, we made an assurance sometime in 2019 that we will monitor the top 100 NBFCs very closely, and that is continuing. So whenever we see a particular sign of stress or a deviation or some misclassification, etc., in any bank or any financial entity, we immediately, it's a kind of ongoing monitoring which is going on. So when you have the CRILEC data system, when you have deepened your supervision, when you are doing online supervision, the need for a AQR, a one-time AQR, is not
required. It is an ongoing
it's an ongoing process.
Okay. Let me come to the other issue on banking, which actually has captured the financial sector's imagination, in fact the economy's imagination, what the government announced in terms of privatization of public sector banks. I would assume that they will be in touch with you. Is there anything that you can enlighten us about what will be the parameters of this privatization? Will it be size-based? Will it be, how much pension, because private parties may not be willing to buy pension? Will it be, number of employees?
No, government as the owner of the public sector banks
Sir,
government has to
on
decide.
you, sir.
No, government has to decide. It's a major, it's a major reform which the government has embarked upon. So as the owner of the company, they will decide. But nonetheless, I must add that there is a constant dialogue between the Reserve Bank and the central government. And so far as Reserve Bank is concerned, we are directly concerned with two aspects. One is the fit and proper criteria. The new owner should meet the fit and proper requirement of the Reserve Bank. Number two, we would be very keen that the bank post takeover is well capitalized and the promoter, whoever takes it over, has enough financial strength to capitalize the bank significantly. So the bank has to be well capitalized post privatization, and whoever takes over has to meet our criteria. Other than that, the approach, etc., these are constantly under discussion, and government does consult us as and when required, but final call will be that of the government.
But it is a long process, isn't it? They have to first render the Banking Companies Act redundant, isn't it?
Some amendment to the Bank Nationalization Act will be required, and I think government is working on that.
Okay. We should see the privatization in FY22, you think?
I can't say that. Government has made a commitment, and I have reasons to believe that government will stick to that.
Okay, the other big announcement, which was extremely well received by the banking system, by borrowers and depositors, is the bad bank. I mean, I think I shouldn't use that term. They have an asset reconstruction company idea. Can you enlighten us on anything, any update on whether banks only will capitalize it, will government capitalize it? How far is it?
I think the government has articulated its views, saying that it will be a bank-driven exercise, that new entity will be a bank-driven entity, which means that the capital will come from the banks. And we already have certain regulatory frameworks, regulatory guidelines for the ARCs, and it will function as per that.
Okay. Any update on when we should see it? Is there some timetable in your mind?
I think the Secretary, Department of Financial Services will be better placed to give that exact date. Okay. But a lot of work has been done, both in RBI, in government. A lot of work has been done, so I would expect this to take off quickly.
Okay. No, in the past, whenever some overseeing department, if you remember, was announced for that, one of those restructuring schemes, the government also depends on RBI to staff it, because you'll have the capability. Conversation has not come to that point?
No, we are constantly in dialogue. Okay. Before the budget, after the budget.
Okay. All right. Now, finally, I must come to the other issue on Rupee. The RBI has, a problem managing it, because there is so much of inflows. Is there a fear that this Rupee appreciation, what is the view at all? You think we have to reconcile ourselves to appreciation because of the way in which the dollar is declining, the way in which flows are coming?
See, we cannot reconcile ourselves to every situation or any situation. We will deal with it as the situation evolves. We will deal with it. Our main objective in all these, the exchange rate management, our main objective is that it has to be to control the volatility. To control the volatility of the rupee, and that is precisely what we are doing. And another positive development which augurs very well for our external sector is that our forex reserves are at all-time high, yes. 583 billion. So,
yes, that is a positive, but that also means that it may increase even more if you have to continually buy. The flows are.
I think once.
Is there a fear of this? Currency manipulator tag?
No, I think I have already articulated that emerging market economies will have to build up their own buffers to deal with a situation when there are reverse capital flows. So today we are far better placed, and we do not expect the kind of crisis which happened during the taper tantrum, because our reserves are far more robust, and that gives confidence to the international investors also, apart from the domestic investors, it gives confidence to the international investors, both FDI and FPI investors, about the stability of the Indian rupee, that the Reserve Bank will maintain the overall stability of the Indian rupee.
Okay. Well, just a final question to you, sir. What is your sense about inflation? RBI has given a forecast of 5 to 5.2 for the first half and 4.3 for the third quarter. But when you come to the fourth quarter of FY22, there is a low base, there is commodity inflation, crude price rise. Is that a nagging worry that inflation is a fear you cannot put behind?
No, the near-term outlook, we have said that the inflation is going to be benign, in the sense that it's going to be, maximum we are expecting is 5 point something.
Yes.
So therefore it's well below 6%. So that is the near-term outlook. And what augurs well again is the food crops. The Kharif crop has been good. The Rabi crop has been good. Kharif sowing has been good. And core inflation has remained elevated. But let me again mention that core inflation remains at about 5.5, and that range. So, but since there is a inflation expectation issue, and that inflation expectation is today well anchored, I do not expect inflation to sort of, I do not expect suddenly inflation to spike, because the Reserve Bank has the necessary, tools to monitor it very carefully. And whatever projections we have given at this point of time, we stick to those projections. So the near-term outlook, the inflation is going to remain well within the 6% upper threshold.
Okay. Well, is there a chance that growth can be much better than you thought? I mean, there are forecasts out there which are looking at 13% next year. I think that is the Nomura forecast. So there are people who are expecting even much above 11%. I think 11 is S&P. Do you think a positive surprise is possible?
No, if the growth is higher than what we have projected, we will be happy, and that will be one number we will be very happy to be proved wrong. Of course, if it is in the upwards of 10.5% what we have projected. And so that should augur well for everyone. The government revenues will go up, government expenditure will be supported, and the savings, the financial savings also will go up. In fact, incidentally, the bank deposits have grown by about almost 11% over the last 1 year. And so credit offtake, private sector investment also should crowd in. So a higher growth is always welcome.
Okay, no, I was just wondering if you're expecting that. Final word, 6% was the Lakshman Rekha for tenure. It looks like you are okay with a little rise. We have seen it gone above 6.1. Is there anything you want to tell the market about that? Plus minus in terms of your tolerance band?
No, I just want to repeat by saying that, you said 6% is the Lakshman Rekha or something. You used.
Or so it seemed, because you rejected so many.
Now, it all depends on who draws the Lakshman Rekha, or what some people call as the line in the sand. It depends on who draws
the issuer was drawing it, not your problem.
Who draws that line. And as the debt manager, once the central bank draws a line, it is a line. Okay. But on a more serious note, let me say that what I have said very clearly, that we are looking at, I have again articulated in October policy statement, and again in what I said earlier was on a lighter this thing, but on a more serious note, what I said in October policy statement and again in the February MPC statement, markets and the central bank, there should be cooperation to ensure that it's a public good. Orderly evolution of the yield curve is a public good, and it entails a responsibility both for the central bank and for market players. So what we are looking for is orderly evolution of the yield curve. I think I have given reasonable amount of clarity to the market.
You indeed have, sir. Thank you very much for clarifying so many things and speaking on our channel. February 26th is your birthday. I do hope that the forthcoming year, both for you and the financial year for the country, is a great one. All the very best to you.
Thank you. Thank you very much, and thank you to all your viewers. Thank you.